One, interestingly, business volumes are actually relatively resilient. And we haven't seen the precipitous fall off a cliff that we thought we might start seeing at this point in time. You could argue some of it might be a bit of a last hurrah before the slowdown in the second half. But in reality, loan volumes, deposit volumes, even business fee-generating activities are holding up. This is true in some industries, real estate, TMT, and in some countries, Taiwan, China, locations are doing okay. So that's on the one level. The biggest headwind we have, obviously, is the interest rate. The big cuts by the Fed eventually trickle through into our interest rate environment, and that's likely to produce the biggest headwinds for us in the course of this year. But the third dimension is cost of credit, of course, and that's much harder to call because there will be damage in some industries in particular, aviation springs to mind, oil and gas, and so on. There will be some damage. We've been trying to potentially try to figure what it might be, which is why some of those forward-looking reserves and provisions you talked about have been taken.
How long until you think we'll see a normalisation in rates, particularly when it comes to the Fed? You did see a 2 basis point reduction in your net interest margin in the first quarter on a year ago. What do you anticipate the second quarter will look like when it comes to the margin side of things?
Oh, much poorer, because the Fed rate cut only happened in the middle of March. And because of the strained money market conditions, LIBOR and all that other attendant benchmarks stayed high. But as you go into second quarter, you will see that drop off quite sharply. So I think you should expect to see those interest margins come off another 8-10 basis points in the second quarter.
You mentioned exposure to the oil and gas space, and of course we have seen prices absolutely hit rock bottom. How significant will that be over the course of 2020 for DBS?
Well, we did some disclosures at our results this morning. The whole oil and gas complex is about 7 or 8% of our loan book. And within that, there are gradations. The bulk of our exposures are to very high-end players, the global majors, the state-owned oil companies, etc. And our stress testing suggests that even in $15, $20 oil price conditions, these large companies will be okay. They have enough sources of liquidity, including lines of credit. Our actually yield continues to be the residual exposures we have in the support services sector, the offshore marine sector. Now, fortunately, 3/4 of that is already booked into non-performing, but we do have a few names left in that sector that we'll have to watch for.